The screen glows. A number flashes. Money moves. Someone just received their salary. They click a button. Part of that money vanishes. It flows to a bank. This is a mortgage payment. Another click. Money flows to a credit card company. In another city, an official approves a payment. Billions move from the state's account to investors. All day, every day, cash flows like this across the globe. We can understand a lot about our economy if we just follow the cash flows. Many of these flows are driven by one idea: debt. Debt is a promise to pay money back later. One of the oldest financial tools. People have always lent and borrowed. Buy homes they cannot afford outright. Start businesses that need equipment. Build roads. Build schools. It allows us to pull future earnings into the present. That lets us do things now that would otherwise wait. When used well, it supports growth and stability. When misused, it creates fragility. It can amplify small problems into system-wide disasters. To see both sides, look past borrowing. Follow the intricate pathways of cash these promises create. Imagine a large, complex irrigation system. Canals, pipes. Water flows from a reservoir to countless fields. A well-designed system delivers predictable water to each farmer. That lets them plan planting and harvesting with confidence. The water flows steadily, supporting a bountiful crop. But if the main dam is weak, or the canals are poorly maintained, a crack can lead to a flood, washing away crops. Debt works similarly: predictable flows, but risk of destructive floods. At its core, debt is about structure. It takes a large, one-time sum of money and breaks it down into a series of smaller, regular payments. Think about a family that wants to buy a house. They likely do not have hundreds of thousands of dollars sitting in a bank account. A mortgage solves this problem. A bank provides the large sum up front. The family, in return, promises to make a fixed payment every single month for many years. This transaction creates a predictable cash flow. The family knows exactly how much money they need to set aside each month. The bank knows exactly how much cash it will receive. This predictability is incredibly valuable. For the family, it makes budgeting possible. For the bank, that steady stream of incoming payments is a reliable asset. The bank can use this expected income to pay its own employees and to pay interest to its depositors. Crucially, it can use this predictable flow to make new loans to other families and to businesses. The single act of creating one mortgage generates a clear, dependable movement of money that helps other parts of the economy function smoothly. The debt contract turns a lumpy, difficult purchase into a smooth, manageable expense. A small manufacturing company wants to expand. It needs new machinery. The machines are expensive. Paying all at once would drain cash, leaving it vulnerable. The most common example of debt for a household is a mortgage. This is a loan used to buy a home. For most people, a house is the single largest purchase they will ever make. Without a mortgage, home ownership would be a distant dream for all but the wealthiest. The bank lends the money. The family agrees to a payment schedule, often 30 years. Each month, a portion of the family's income flows to the bank. That single transaction stabilizes two budgets at once. The family has a fixed housing cost. The bank receives a reliable stream of cash. This arrangement affects the wider economy. Because banks can count on mortgages, they lend more: car loans, student loans, credit cards. Each product creates a predictable payment flow. Student loans let someone invest in education now and pay it back from higher future earnings. The bank gets long-term income. The student gets a degree. Debt helps build a skilled workforce and enables mobility. It turns big upfront costs into small regular payments. Governments rely on debt too. They fund roads, schools, bridges, hospitals. These projects are massive and expensive. Funding them from one year's taxes is impractical, so governments issue bonds. A bond is a loan. An investor buys a bond. The government pays regular interest, coupons, and later repays principal. Build now, pay over time. Citizens benefit immediately. Costs spread over years and taxpayers. Investors like pension funds and insurers find these debts very safe, count on coupons to plan pensions. Public debt, managed responsibly, smooths spending and provides safe assets for savers. Banks and other large financial institutions take the basic idea of debt and build more complex structures with it. One of the most important techniques they use is called securitization. This is a fancy word for a simple process, bundling many individual loans together and selling them off in pieces. Imagine a bank has thousands of mortgages. Each is a steady stream of payments. The bank pools the loans, divides the payment stream into securities, and sells them to investors. This moves cash flows from one place to another on a massive scale. An investor, perhaps a pension fund in another country, can buy a piece of this bundled debt. They are entitled to a share of payments made by homeowners thousands of miles away. This might sound complicated, but the goal is predictability. Securities are designed with specific schedules. Some pieces pay monthly and are very safe. Other pieces are riskier, paying after the safer ones but offering higher returns. Securitization helps institutions manage risk. By selling loans, a bank gets money back immediately and can make new loans. This keeps money flowing and spreads risk among many investors worldwide. These institutions need long-term, steady income. Bonds and mortgage-backed securities that pay set amounts for years let them match assets to promises to pensioners. Beyond households and governments, debt is the lubricant that keeps the gears of global trade turning. Consider a smartphone maker needing millions of parts from suppliers around the world. They might not have cash up front. Instead, they use short-term debt called trade credit. The supplier ships now, and the manufacturer agrees to pay in 30, 60, or 90 days. Production continues without interruption. This act of trust, backed by a debt contract, is essential for supply chains. It smooths the production cycle and reduces working capital needs. Without trade credit, production slows, growth stalls, and goods get pricier. Debt bridges the time gap between buying materials and selling the final product. When a firm sees opportunity, new factory, new market, new product, it often needs large capital quickly. Issuing bonds or taking loans raises funds now. Investors expect regular interest and principal back later. A renewable developer may issue long-term bonds to fund a solar project that pays investors predictable income for years. Debt enables innovation, jobs, and growth. Projects that wouldn't happen from cash on hand alone. Again, follow the cash flows. The same structures that make debt so useful can also make the financial system fragile. The predictability of debt depends on one crucial thing. The borrower must keep paying. When a few borrowers fail to pay, it's a manageable problem. But when many stop at once, the steady flow turns to a trickle and can stop altogether. Loans are linked in a complex web. One person's failure can trigger a chain reaction. A local problem can become a major crisis. This risk is called systemic fragility. If a recession hits and many lose jobs, mortgage defaults rise. The bank gets far less cash than expected. To cover expenses, it sells assets quickly. If many do this, prices plummet. Other banks see values fall and get scared. They stop lending to each other, fearing non-repayment. Interbank money flow can freeze. Complexity amplifies the problem. When loans are bundled and sold worldwide, it's hard to know who holds the risk. If original loans go bad, fear spreads. Investors doubt the quality of their securities. Trust evaporates. Markets halt. That happened in 2008. An interconnected, opaque system turned a corner problem into a global credit freeze. Another major risk is leverage. Leverage is using borrowed money to enlarge a bet. For example, a firm uses $10 of its own and borrows $90 to buy a $100 asset. If the asset rises 1% to $101, the firm makes $1 on $10, a 10% return. But losses are magnified too. If it falls 10% to $90, the firm loses its entire $10. High leverage destabilizes the system. If many firms are leveraged, a small drop can cause bankruptcies and a domino effect. That domino effect can be devastating. So, how do we benefit from the good parts of debt while controlling its dangerous side? The answer lies in smart design and sensible rules. The goal is not to eliminate debt, but to build a system more resilient and less prone to collapse. The first and most important rule is transparency. If investors and regulators can clearly see who owes what to whom, they can judge risk better. Clear loan contracts and disclosure requirements make finance easier to understand. When cash flows are visible, hidden risks struggle to build up. Second, the system needs buffers. Banks and other institutions are required to hold capital reserves. This cushion absorbs losses. Strong capital helps withstand a wave of defaults. Rules can force more capital in good times, and stress tests check resilience in recessions. Third, incentives must be aligned. Before 2008, some lenders profited from making risky loans and passing the risk on. Requiring lenders to keep a portion ties rewards to long-term outcomes, not short-term gains. Fourth, emergency backstops. When panic freezes credit, central banks can lend to sound banks to prevent a liquidity crisis becoming a solvency crisis. But backstops must be used carefully, with strict oversight to avoid encouraging excess risk. Debt is not inherently good or bad. It is a powerful financial tool that turns a promise about the future into cash today. This simple function has enormous benefits. It makes money flows predictable, helps households buy homes and plan, helps businesses invest and create jobs. Ultimately, it is helpful to think of the debt system as a great bridge. A well-designed bridge is a marvel of engineering. It connects distant points and lets traffic flow quickly. It fosters commerce and brings communities together. But it must be built on a solid foundation. It requires constant maintenance, clear rules for how much weight it can carry, and safety inspections to spot weaknesses early. A poorly built or overloaded bridge is a disaster waiting to happen. Our financial system is that bridge. Designed with transparency, proper incentives, and robust buffers, it can safely carry the weight of growth and prosperity. It connects savers with borrowers, the present with the future. The key is to never forget that the bridge needs tending. We must continue to follow the cash flows, watch for signs of stress, and reinforce the rules that keep it strong. That is how we can harness the immense power of debt to build a more stable and prosperous world. If this was insightful, please like and share. Debt Explained. Financial stability. Hidden rules.